Chapter 19, Investments. Did you know that investments make up 15% of the GDP? In the last chapter, we saw how consumption makes up almost 70% of the GDP. So if we understand consumption and if we understand investments, we can talk about 85% of the GDP. So what are the components of investments? There are three components: fixed investments, which are factory, machinery, buildings, property. There's inventory investments, investments in raw material that's in progress of being made into the final goods. These are final goods that you have made and are on the shelf ready to be sold. It could be car on the parking lot. It could be car in your with the dealers. So it's an inventory that is ready to be sold. And investments also happen in residential new homes, where there are lots of tax deductible incentives in the United States, where on the mortgage you can deduct from your taxes the interest that you pay. So that encourages people to make investments in real estate and residential properties as well. So there are these three components of investments. All of these three components of investments are pro-cyclical, meaning with market cycles, they move in the same direction as the market cycle, and they are very volatile. Given the small percentage, especially the inventory part is the most volatile part of these investments. So now that we understand investments, let us look into two theories that tell us like what causes someone to invest. And the first theory is called the neoclassical theory, and the second one is called Tobin's Q theory. So we'll go through neoclassical first. Tobin's Q is built on top of neoclassical. So let's understand neoclassical theory. Neoclassical theory, in simply one line, basically says marginal product of capital is equal to users' cost of capital. Until that happens, investments will either fall or will rise. So investments will increase if your marginal product of capital is higher than the user's cost of capital. So now let's look at this. Basically, it's saying MPK equals UC, marginal product of capital equals user's cost of capital. So let's understand these two terms a little bit. Marginal product of capital basically says, if I use the capital that I have and build these inventories and build these investments, for that investments that I do, marginal product, what is the end product that I will make? So let's say I spend in $10, right? And I can make $100 out of it. So I made $90. So my marginal product of capital is basically saying, hey, I made $90, right? So as long as the $90 that I made on top of the $10 is profitable, when for me to, I could, my user's cost of capital, my cost of capital of that $10 that I used for this endeavor to create from $10 to $100, as long as that is profitable for me, I will continue to do it. So a company will keep investing as long as its marginal product of capital is greater than its user's cost of capital. So if it can borrow money for cheap, and if it has a profitable business idea, it will continue increasing investments as long as there are no borrowing constraints. So basically, that's very intuitive, but that's the theory. That's the neoclassical theory that says that investments will continue to happen as long as these two equate, wherein the marginal product of capital equals user's cost of capital. So marginal product of capital can be, is a curve that's downward facing, and user's cost of capital is a fixed line. Because think about user's cost of capital as three different things, which we will get into. But if let's say if this is the point where they intersect, MPK and UC intersect, if my investments is in this and in this zone on the right hand side of my optimal, then my investments will fall, meaning I will not replace my inventory that's worn out. But if my investments is in my capital is lower than the optimal, then I will continue to invest more, meaning I'll build more factories because my business idea is profitable. So think about this. Your capital investments increases if your marginal product of capital is greater, right? So that's the key intuition behind this piece. So now let's look at like, okay, so if I want to now understand this a little bit more, I have to understand like, what is my user's cost of capital? If I'm a user, if I'm a company, if I am an entrepreneur trying to invest, what is my user's cost of capital? User's cost of capital basically says, if I want to use $100, which is my price of capital, it depends on the real interest rate, the depreciation, the rate of change of my PK, right, which is basically what is the rate of change of PK over PK, which basically is saying what is the rate of change of my PK, capital, price of capital, right? So price of capital multiplied by this term, because the way to think about this intuitively is basically saying, hey, if I'm borrowing $100 and if I'm paying the rate of interest, real interest rate is 3%, and if my depreciation is 5%, so then basically I'm going to do 5 plus 3, 8, and then if my rate of change of price of capital is 2%, then it'll be 6%, right? So 5 plus 3 minus 2. So it's basically saying, hey, you are going to pay because this is your opportunity cost, real interest rate. Depreciation is you have to reinvest that money. And then that's divided by 1 minus tax percentage, because it's not just MPK equals UC, as simple as that. It's actually divided by 1 minus tax percentage, because even if I made that $90, I have to pay maybe $20 or $30 to the United States government in terms of taxes. So MPK equals UC over 1 minus tax percentage. So if it's 30% tax bracket, then this will be 0.7. And then UC is basically price of capital times interest rate plus depreciation percentage minus the rate of principal price of capital, change of price of capital, right? So basically it's saying, hey, until these two terms are equal, your investments would have to adjust, right? And if it's lower, then it's going to increase the investments. If it's higher, it's going to decrease the investments. So far with me, right? So your cost of capital can be broken down, and it has an impact on the real interest rate, depreciation, how much are you changing in terms of the price of capital. Like, so if let's say you build a factory today, so to think about this, like let's say I'm going to put numbers now, and let's say this is 3% interest rate and depreciation is like, let's say 2%, and then price of capital, think about this term, the rate of change of price of capital is basically saying, hey, if you build a factory today, you can build for $20. But if you same factory, if you were to build tomorrow, it's going to build in like $30. So then all of a sudden it's cheaper to build factory today if the opportunity cost of the $10 is lower. So basically this saying, hey, is it going to get expensive to buy that computer, that hardware, that machine, that property that you're going to build? If so, then that's actually working in favor, right? So if let's say this is 1%, and then tax percentage is like 0.3, so 30%, then you can easily calculate this would be equal to 3 plus 2, 5, minus 1, 4. So 4 times, so this would be 0.04, right? Because it is 4% times PK over 0.7, right? So that is, so when MPK equals this number, that is the ideal point for you, right? So far with me. So now let's look at what happens when, let's say, your MPK goes up, marginal product of capital goes up. This happens when and we've seen this in the previous videos, if your productivity of your employees goes up, then marginal product of capital goes up. If the output goes up for any other reason other than productivity, because you've increased labor, you've increased capital, then if your MPK goes up, and if your UC, right, this is UC, which is user's cost of capital, is flat, we just see that, hey, capital level will go from K1 to K2, right? So when MPK goes up, the capital goes up and investment goes up, right? Similarly, what happens when, let's say, interest rate goes up? When interest rate goes up, the user's cost of capital goes up, meaning it's more expensive to borrow, right? So then in that case, what happens is the capital actually reduces. So when investments, when users cost goes up, capital goes down, investment goes down, right? Similarly, if it's cheaper to borrow and build this property today, then it's actually opposite, meaning my user's cost will go down if I were to do it today. So it's better to build that property today. Similarly, if my price of capital is going to continue to go up, my user's cost of capital is going to go up, and user's cost of capital goes up, then investment, goes down, right? So like when user's cost of capital goes up, investment goes down, and similarly the opposite. If user's cost of capital goes down, investment goes up, right? So there's an inverse relationship between these two, right? So once we understand that, and same for depreciation, and you can use this formula to find out, hey, if my depreciation goes up, my user's cost of capital goes up, and then my investments go down, right? Similarly, taxes. If government adds more to my tax liability, then my user's cost of capital goes up. My user cost of capital goes up, my investment goes down, right? Similarly, if I have a profitable business idea but I just cannot borrow money, then similarly, if my financial constraint goes up, user's cost of capital goes up, investment goes down, right? So these two will help us very quickly understand like what happens when interest rate, depreciation, taxes, financial constraints, how does all of these change my desired level of investment, right? And so once we understand like my user's cost of capital, which we saw through the breakdown of this formula, right? And then we understand my desired level, the optimum level, then my investments will follow that. If it's lower, it's going to increase. If it's higher, it's going to decrease. But investment net is basically your net new investment, which is this delta here, plus the depreciation. So whatever your depreciation is, you have to add to that. So now we understand neoclassical theory. Now let's look at Tobin's Q. Tobin's Q is basically saying Tobin's Q equals market value of the firm divided by replacement cost of installed capacity. To think about this in this formula, the formula of getting to this Q, think about this as the two equations, right? Market value of the firm, which is very easy to find out. If you look at any stock market public company, if you want to find out its market value, you can go to Yahoo Finance or Google Finance and find out what's the market cap. Because of the stock price, you can know what the market value of the firm is. And now think, what would be the replacement cost to build the same firm today? Like let's say you were to build a steel company and you find that there's a $10 billion steel company, but you can replace that same steel company with the exact same capacity in $5 billion, right? So your Tobin's Q would be like higher, greater than 1, right? Similarly, if the $10 billion company can be replaced only by a $100 billion investment, and the Tobin's Q would be different. So Tobin's Q is actually adding on top of neoclassical theory. It's basically saying, hey, if my stock prices go up, meaning everyone expects that my company will do better because stock market prices are nothing but the leading indicators of my future cash flows, discounted future cash flows. If my stock prices goes up, my market value of my company goes up. Market value of my company goes up, Q goes up because the numerator is going up. When Q goes up, investments actually go up, why does investment go up when Q goes up? It's basically saying the company is having marginal product capital greater than the cost of capital. That's why investment goes up. And similarly, if stock price goes down, market value goes down, Q goes down, investment goes down, right? So the key takeaway is that the stock market fall, an aggressive fall in the stock market, plays a very important role in producing recessions. Because what do? When this happens, investments in all of these categories go down drastically, and inventory goes down the first, right? And so when that happens, there's potentially a lost sale because there's not enough. There's fluctuations, right? Because there's not enough being built, and so the economy suffers. Especially this 15% of the investment suffers in a pretty big way. So one other way to look at it is that the stock market, if this is aggregate supply and aggregate demand, your aggregate demand actually falls, and so your output falls, right? And your inflation also falls. So it goes from 1 to 2 when the stock market falls. Stock market falls, aggregate demand falls, output falls, inflation falls, right? So stock market thus is a very good leading indicator of recessions, right? We've seen this in the previous videos too. And so it's very important to understand why is that the case. Because of investments going down. People, when they have their investment in stock markets, then they go down, then they'll have less wealth. And we've seen this in the previous videos. Consumption also falls, but most importantly, investment falls very, very rapidly. Companies cut costs, they fire people, right? So it's very important to understand that marginal product of capital has to be greater than the user's cost of capital for any investment to make sense. If not, the company is just losing money. So the company will continue to invest more and more as long as every new dollar that they put in the company is able to make more dollars out, especially at the margin. So hopefully these two theories help us understand how real interest rates play an important role, how depreciation, how taxes, how financial constraints, how the stock market plays a huge role in terms of recessions, in terms of investments, how investments are formed, and how depreciation has an important role as well, right? Thanks.